Hello and good morning. You're watching Market Cafe. I'm Ankita Saxena and with me is Shristi Sharma. And in the next 1 hour, we'll take you through all that transpired on the global front, the heating up of geopolitics and, of course, its impact on the markets before we start trading for these streets. But first up, let's take stock of how the Wall Street shut shop on Friday. Well, it was a sea of red coming in. Now, remember, President Donald Trump ordered on Friday some strikes on the Iran military assets located in the Kar Island. Now, while the attack didn't really impact the oil infrastructure, Trump said that the U.S. would consider hitting those structures if Iran continues to block the Strait of Hormuz. Now, remember, we do see that impact coming in. Now, Brent crude shot up post the $100 per barrel mark. And on the back of that, that is having a ripple effect on the global markets. In fact, in the U.S., S&P 500, that shut shop at the lowest point in this year. In fact, it was the third straight week of losses for S&P 500. That traded down 1.6% down. For the week, we had Dow Jones that fell 2% for the week, and we also had Nasdaq that was trading with cuts on Friday. It was down almost 200 points, almost a percent downtick coming in on Friday as far as Nasdaq is also concerned. Now, remember, we do have this tension that's going on, and on the back of that, we do have oil prices that are seeing a sharp surge, and on the back of that, that's having an impact on the markets as well. So, Shrishti, tell us, where is the crude at, and how is that faring right now?
Good morning, Ankita, and good morning to all of our viewers. Yes, the crude is one of the biggest talking points yet again for the markets, because just on Friday, we have seen that, yes, of course, the crude oil prices were actually higher above that $100 per barrel mark. And over the weekend, the biggest news was the U.S. attack on Kar Island. But to the surprise, as of now, there has been no significant jump up with respect to the crude oil prices. Brent crude is hovering around that $102 per barrel mark, and even WTI crude is actually down 0.5% as we speak right now. It is below that $100 per barrel mark, but yes, that is one of the biggest talking points yet again, because what happens to the Strait of Hormuz. And over the weekend, we have also seen very interesting comments coming in from Iran's spokesperson, where he says that the Strait of Hormuz is open, but not for the enemies right now. And good news for India, because we have seen so many news flow around that how the ships are being allowed to go and pass through the Strait of Hormuz, and maybe a reason, Ankita, that GIFT Nifty is also indicating a positive start for us.
Absolutely, Shrishti. After the carnage that we saw last week, at least some bit of a breather coming in on this week, especially the implied starter Nifty that's seeing an uptick of 100-odd points. But let's talk about U.S. and Iran, as the war has entered its 16th day, and the U.S. ambassador to United Nations, Mike Waltz, has said that Trump is weighing strikes on oil infrastructure on the Kar Island. Trump has directed the U.S. Central Command to carry out a bombing raid on the Kar Island's military targets for the first time, but left the oil infrastructure intact. Now, Trump has threatened further strikes on Iran's oil export hub, even as repeatedly he urged the allies to deploy warships to help the U.S. secure the Strait of Hormuz. And Iran's Foreign Minister Abbas Araghchi took to social media and stated that they are ready to form a committee with the countries of the region to investigate the targets that were attacked. Well, let's go across and listen into what President Trump had to say.
We attacked Kar Island, and we left just the one little area standing, and the standing part is where they have the pipes, all the oil pipes come in. And we could do that on 5 minutes notice. We have it all locked and loaded and ready to go if we want to do it. But we chose not to do it. I chose not to do it yet. We'll see what happens. They want to negotiate. They want to negotiate badly. I don't think they're ready. Just what I'm hearing. They want to negotiate badly, as they should. But I don't think they're ready to do what they have to do. But I think they will be ready at some point. But we're doing very well with respect to that whole situation in Iran.
And the International Energy Agency has confirmed details of its emergency collective action announced on March 11 to stabilize the global oil markets amid the disruptions caused by West Asia conflict. Now, member countries have agreed to release around 400 million barrels of oil from strategic reserves, the largest coordinated release in the agency's history. Now the move aims to offset the kind of disruptions that are linked to the tensions around the Strait of Hormuz, the key global oil transit route. Much of the supply from the Asian members will be made available immediately, while additional volumes from Europe and the America are expected to reach the markets later this month.
And more on the war front, both US and Iran has signaled they are prepared for a prolonged conflict. Iran says it is ready to fight for as long as it takes, rejecting claims that it is seeking a ceasefire or negotiations with Washington. US President Donald Trump, meanwhile, has said that he is not ready for a peace deal, citing terms are not good enough yet and claiming that Tehran was keen to negotiate a ceasefire.
And in other news, officials from the US and China have begun a new round of trade and economic talks in Paris aimed at easing the tensions between the world's two largest economies ahead of the possible summit between US President Donald Trump and Chinese President Xi Jinping later this month. Now, talks are being led by the U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Ling, with negotiations focusing on tariffs, export controls, rare earth mineral supply, and Chinese purchase of U.S. agricultural products.
And U.S. economic growth slowed more sharply than previously estimated in the fourth quarter of 2025, according to revised data from the Commerce Department. U.S. economy expanded at an annualized pace of just 0.7%, sharply lower than the earlier estimates of 1.4% and far below the 4.4% growth recorded in the previous quarter. Now, the GDP growth for the full year has been revised to around 2.1%, signaling that the economy lost momentum towards the end of 2025, even as the policymakers continue to monitor inflation and global risks.
All right, with this time, it's time to slip into a very short break. Don't go anywhere. We'll be right back.
We need to watch out for before the start of the street, and let's take a look at how the Asian handover looks like. I mean, just like the US handover that had a negative handover, even Asian market looks in the red. Nikkei is trading down almost 364 points, 0.6% cut coming in on the Nikkei. Now remember, it's the crude prices that's remained elevated. In fact, it is hovering around the $100 per barrel mark, and that is really weighing heavily on the global markets. And on the back of that, Nikkei is down 0.7%, Hang Seng trading down 0.1%. Shanghai is giving very flat moves, though in the red. It is trading absolutely flat. ASX S&P 200 is trading with cuts of 0.2%. But what is really giving a surprise start is the implied start to Nifty. That is bucking the trend. In fact, that's the outlier as far as the global markets is concerned. 100 points of an uptick is what we are seeing. There's some bit of a buying that can perhaps come into the market right at the start, especially at the kind of rates that we shut shop at on Friday. So that could be a buy on dips market. And Shrishti, maybe that's why perhaps Nifty is indicating a positive start, at least at the start of the day.
Absolutely, and that's a good indication, rather, Ankita. But apart from the markets, there are going to be a lot of stocks that one should be watching out for. So let me take it across to my colleague Ravinder, who's standing by to help us understand this list of stocks to be watched out today. Good morning, Ravinder.
Well, as Salasa techno engineering can be in focus, where companies say that the operation impacted due to LPG supply disruption caused by the Middle East conflict, leading to effect on the company's production, deliveries, EPC activities, and export to Gulf region. So, back of this, these stocks can be in focus. Another stock that can be in focus is Intergroup Aviation, where company has introduced fuel surcharge from March 14 due to surge in ATF prices, adding rupees 425 per sector for domestic and subcontinental routes and up to rupees 2,300 for Europe routes. CMAC can be in focus, where consortium with Supreme Hydro has received ONGC contract worth of rupees approximately 411 crores. So back of this, these stocks can be in focus. Apart from this, keep an eye on Geo Financial Services, where insurance regulatory has granted certificate of registration to Alliance Geo Reinsurance on 12 March to commence reinsurance businesses in India. So back of this, these stocks can be in focus. On the real estate, keep an eye on Brigade Enterprise, where Buzzworks has leased 550 seats office space to My Compliance office at Mindspace Business Park, Hyderabad, taking total lease space in the city to 1.1 lakh square feet. GMR airports can be in focus, where company has received LOA from DIL to upgrade, operate and maintain cargo terminal 1 at Delhi airport with an estimated 340 crore shares in the first full year and concession valid up to 2036. And apart from this, the company has also announced that traffic data, where company says the company has received a resilient traffic at the GMR airport, served at approximately 10.3 million packs in the Feb 26 across all GMR airports. Bejil projects can be in focus, where company has received ultra mega EPC work order of rupees 700 crores. So back of this stocks can be in focus. Keep an eye on KRN heat exchanger and refrigerator, where board has approved QIP worth of fundraise worth of rupees 500 crores via QIP. And lastly, keep an eye on JSW Steel from the steel sector, where company has announced the MDR coking coal mining project in Mozambique, and this grants JSW Steel access to the substantial reserves of the premium hard coking coal, which is a key raw material in steel making. So back of this, JSW Steel can be in focus.
Thank you so much, Rabinder, for getting us that list. But other than that, whole host of other counters to be watched out today. And first up is Vatek Vabag. A very positive news flow coming in as their JV bags an order securing ABD-funded mega deal from Chennai Metropolitan to build Chennai's cities-wide looped water grid project that will be completed within 54 months. This particular deal size hasn't been something that the company has disclosed, but generally they consider to be saying the deal is mega in terms of the order size when it is worth over 1,000 crores. Other than that, Brainbee solution is going to be in focus as well, because First Cry is seen to be scaling a quick offering across Bangalore, Pune as well as Hyderabad, and that is another positive news flow coming in on Brainbee solution. Aster DM is going to be in focus as the nursing staff across hospitals in Kerala has been participating in the statewide strike from 9th of March, and these strikes are expected to temporarily disrupt the operation. So a bit of a negative news flow coming in on this particular counter. Fino Payments is going to be in focus as well, as the company has come out with a business update. The bank has recorded its highest ever total deposits of 2,900 crores. So a positive development over here. Railtel, on a back of a positive news flow of new order wins, they have received work order from Uttar Pradesh Police Recruitment and Promotion Board worth 30 crores and an LOA from South Central Railway worth 34.2 crores. Dilip Bitcoin will be in focus as well on the back of a new order win worth 160 odd crores. So let's watch out for that. Vare Energy will be in focus as the company has announced India's largest 10 gigawatt of integrated ignot and water manufacturing facility in Nagpur that will have an investment of 6,200 crores. So that's a big one coming in on Vare Energies. Tatwa Chintan, a negative news flow. The gas disruptions have led to temporarily disrupt the operations. The company has been trying to arrange some alternative fuels, is what they are saying. Adani Power, a positive news flow coming in over here as they have received an LOA from Maharashtra State Electricity for supply of 1,600 megawatts of thermal power under a long-term supply agreement. So let's watch out for that. And lastly, Gillette is actually in focus on the back of a negative news flow, because Rajasthan State Pollution Control Board intimating a refusal of consent to operate for its Bhiwandi facility and refusal to renew the authorization as well. So let's watch out for this counter as well.
All right, with that, it's time for a quick breather. Don't go anywhere. We'll be right back with more updates on the market. Stay tuned. Ending the session at 92.46. My colleague Anurag Joshi is now joining us with more on the rupee.
The Indian rupee touched a new low. The rupee fell to a fresh all-time low of $92.49 in intraday trading and closed at 92.46. There was no active RBI intervention seen in the local currency market. The rupee had closed at 92.20 on Thursday. Offshore investors are net sellers of about $7.2 billion of local equities this year, and the BSE Sensex index fell 1.9%. The Thai baht, Filipino peso and the South Korean won are the worst performing currencies in Asia. The shipping blockage in the Hormuz Strait is choking crude supplies, and that is pushing the Brent above the $100 a mark, and which is leading the rupee to come under pressure, and the rupee is for this reason seeing new all-time lows.
All right, thank you so much for that. But moving on, and divergent views coming in into the state of Indian economy. On one hand, Goldman Sachs has actually slashed India's 2026 growth forecast to 6.5% from 7% earlier. And on the other hand, Fitch has raised the growth expectation to 7.5%, even as they expect the growth to moderate for the next 2 years. Anurag Shah joins in with more details.
GDP forecast cut by Goldman Sachs by 50 basis points for 2026. So previously it was 7%, and now it has been reduced to 6.5%. On the inflation front also, inflation now Goldman Sachs expect inflation at 4.2% for 2026. Earlier estimate was 3.9%, but Fitch is more optimistic. So Fitch expects India's GDP to grow at 7.5% in FY26. Growth is expected to be driven by the consumption, especially after the GST rationalization. So consumption will drive India's growth as per the Fitch estimate. But Fitch also says that slowdown in early 2026, like in January and February, and there may be a temporary moderation in the growth in early months. So first half of 2026, the moderation will be there from April to September. After that, economy activity could stabilize. Long-term growth outlook by Fitch is of FY27 it's 6.7%, and further easing to 6.5% in FY28 as the economy will mature, as economy size will be big. Inflation trend ahead as per Fitch expectation is 4.5% by December.
And well, the government has notified amendment to Securities Contract Regulation Act that will help large corporates sell equity via IPO. This tweak comes ahead of the big IPOs like Reliance Jio and NSE. Anurag Joshi is joining in with more details.
The government has notified a key amendment to the Securities Contract Regulation Act in a step that will help large issuers such as Reliance Jio to list their shares. The step will help large issuers to sell equities to the public via IPOs. A key part of the notification is that at least 2.5% of the equity shares or convertible debentures which have been issued by the companies could be offered to the public. This will allow those companies which have a jumbo valuation to go ahead with their listing plan with more ease. The amendments were notified in the government's official gazette, and the companies with equities which provide superior voting rights to the promoters and to the founders will have to compulsorily list such shares along with in the same exchange along with the ordinary shares issued by the company. Whether shareholding at the time of the listing is less than 15%, this company has to raise the level to at least 15% in a time of 5 years and to 25% in within 10 years of the listing of the shares. And whether public shareholding at the time of listing is 15% or more, the company has to raise this to at least 25% of the shareholding within 5 years of the listing of the shares. The notification follows SEBI easing the minimum public shareholding guidelines last August, and the SEBI had set a criteria for the shares to be offered to the public according to the post-issue capital of the company.
All right, thank you so much for getting us all those details. But the strategic divestment of ITPI Bank is unlikely to proceed as the bids received from suitors, including Fairfax Financials and Emirates NBD, were below the government's set reserve price. Let's listen into more details from my colleague Prakash.
Well, a setback for the government's disinvestment strategy, as we are learning from our sources, that the disinvestment of IDBI Bank is unlikely to proceed as the financial bids received for the bank are below the reserve price. That's an important development coming in at this point of time, as sources suggest that the government has held a meeting on the development a few days ago and discussed the future course of action, which would be finalized in the next few days. But a very significant development coming in at this point of time as far as IDBI Bank disinvestment is concerned, as the financial bids received for the bank are below the reserve price, which were invited a few months back after a long gap. But the formal process to stop the transaction will have to be approved by the Union Cabinet, which is a standard process in such cases. But this is a setback for the government's disinvestment strategy. Sources also suggest that the process is unlikely to proceed under the prevailing market condition, especially in view of the West Asia crisis, and government will have to redraw the transaction strategy, whether it will invite the fresh bids or the whole process would be initiated once again. That is something which would be very interesting to see. But at this point of time, this is the development is a setback for the government's disinvestment strategy, which has set a target to mop up rupees 80,000 crore in next financial year.
And well, the Cabinet has approved changes in the guidelines on investment from countries sharing a land border with India. ET now spoke to the DPIIT Secretary for more details on this. Here's an exclusive conversation. Let's take a look.
PN3 was brought in 2020 originally, when there was a lot of undervaluation in stocks on account of the COVID crisis. Things have changed since then. The stock prices are pretty good. Secondly, we have received a lot of representations from investors, especially with regard to those who are situated in countries other than LBC countries. And they have been asking for clarity on beneficial ownership. So that these two are the triggers which have been under consideration with the government.
Right. And, sir, there is a clause that all the approvals will happen within a 60-day window. The other clause is related to beneficiary ownership. But what do you hope to achieve with this in terms of FDI that's coming into the country?
So, number one, it eases flow of investments for the global funds, which are located in countries like Singapore, countries like Europe, and do not have any controlling interest from LBC countries, and do not have a strategic stake from LBC investors in them. So for them, it is going to be a much easier process, an automatic route, a non-government route, and will give them more certainty into where they'll be able to invest.
Right. So what kind of investments do you hope to have with respect to the easing of these rules as far as that is concerned? And how many applications are currently in the process of getting approved?
So, as far as investments coming in are concerned, the feedback I'm getting from investors is very positive.
Okay.
And I hope to see a substantial jump in investment coming in. I'll not be able to give you a figure as to how much more will come in, because it's not only one aspect. There are other factors also which impact FDI flows. As far as investment applications under PN3 are which are there with the government as of now, I don't have figures with me as of now, but we have expedited the process over the last 2 years. It's a much more efficient process, and the time taken for clearing the applications also have come down substantially. Except in certain outlier cases, we are able to do it in a much faster manner.
And moving on to another story, and Cabinet has approved tweaks to PN3 aimed at easing the business and speeding up the investments in the electronics sector. ET now spoke exclusively to Electronics and IT Secretary S. Krishnan, who says the new norm should strengthen the electronics values and supply chain. Here's that exclusive conversation.
I don't think it's a question of relaxation of norms. I think it's more an ease of doing business for certain selected sectors in the case of the 60-day norm, and in the case of the beneficial ownership definition, that is greater clarity being provided so that it's clear as to how investors are to be dealt with. Previously, we've had certain issues where there's an investor from a country which is a permissible investor in India, which would normally be on an automatic route, but where an entity from a land border country has a small shareholding. A small shareholding may be with somebody who is from one of the land border countries. So the question is it to be treated as a company from one of the LBCs, or is it to be treated as a company from the parent location? So just to make sure that there is clarity on that aspect, the same definition which is used in the PMLA legislation is being used here, which is if up to 10% there is shareholding by an entity from a land border country, then in an investor company which is registered elsewhere, which is not from one of the LBCs, then in those cases it will not be treated as a company from an LBC. So that clarity has been provided so that it's easier to deal with these cases. So that I don't think is really a relaxation as such. It's a clarification providing an indication as to what would be treated as beneficial ownership for the purpose of an investor company which is not registered in LBC. So that is one point. The second aspect, I think, is what the government has attempted to do is identify 3 specific sectors where we require investment, where the presence of companies from land border countries is important enough in the sector, where we have to do business with them in order to go forward, in order to develop those sectors within India. One of those is electronics. And as you're aware, even under the regular PN3 mechanism, a significant number of companies or significant number of investments which have been cleared are by companies are in the electronics sector, even under the existing PN3. So in recognizing that this is a segment which is important for investment, what is being done is simplifying the entire process and placing a time limit for the approval.
Right.
So, which means that we are recognizing, what we are basically saying is we are recognizing that investment in the electronics sector is important, and even if there is a company from an investor from a LBC which wants to invest in this particular segment, that would be a fast-tracked clearance. But it has to go through the PN3 process in terms of getting clearance from the various relevant ministries. So that is the only change. So I would say that while there is a fast tracking in the case of electronics, which we believe is important and which will support the investment program in this particular sector, and in a sense it speeds up because a significant number of cases have been cleared in this sector previously. It speeds up the process.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. We'll be right back.
Every business is like a piece of land. From the outside.
Over to you, Ashesha.
Well, yes, Coal India has been in focus for the last several trading sessions, and we have seen quite a bit of divergence in the stock at a time when Nifty has declined 8%, especially after the war broke out. Coal India, the stock has gained nearly 8% over the corresponding period. That's the kind of divergence that we have seen in Coal India's stock prices compared to the benchmark and broader market indices. And we'll tell you why this is happening. First up, surge in coal prices in the global market. Remember, higher crude oil prices on account of higher freight costs has led to higher coal buying in the global market, and that is the reason coal prices in the global market are surging. Other than that, we also have demand, which is on the higher side. Buyers are now securing more cargoes, which has led to higher demand, and consequently, that is leading to higher coal prices in the global market, and that is the reason we have seen a surge in Coal India's stock price. Remember, higher LNG prices prompts vessels to convert from gas to coal as a means of transportation, and this is also another factor which is leading to higher demand and higher coal prices. Let's also talk about why this is beneficial for Coal India, because when international coal prices are on the higher side, domestic buyers usually resort to domestic coal buying because that turns out to be cheaper as compared to international import of coal prices, and that is the reason domestic consumers of coal are now going to Coal India for buying coal. Premiums are surging, especially because the ones who buy in the domestic market buy as a route of e-auction premiums, and that is the reason e-auction premiums are rising in the domestic market. Remember, Coal India generates nearly 10% of its total volumes from e-auction premiums. That is expected to inch higher, and that is the reason Coal India has been surging in the domestic market. Coal fuels nearly 70 to 75% of India's electricity generation, and this time around summer is expected to be hotter, and that is the reason demand for coal in any case is expected to be higher over the next 2 to 3 months. Remember, Coal India is a great dividend yielding stock. It generates about 6 to 7% dividend yield every year. So at a time like this, when markets are uncertain, dividend paying stocks like Coal India in any case are everyone's favorites. Remember, Coal India is agnostic. It is not impacted by any turbulence that takes place in the global market, and this is because most of the sales are generated from the domestic market. There are long-term contracts, and any kind of turmoil in the global market does not have any impact on Coal India's demand whatsoever. Let's also talk about what brokerages are making of Coal India's target price, especially after the run-up that we have seen over the last few trading sessions. The 12-month target price now stands at 437, which is 6.5% downside as compared to the Friday's closing price, which means brokerages now don't see any upside from the current market level. So yes, several factors which continue to remain at play for Coal India, especially surge in demand, surge in e-auction premiums, and higher coal prices in the international market, and that is leading to the divergence that we have seen in Coal India of late.
All right, so that's Coal India, buzzing on the back of that. Thank you so much for joining us with the detailed lowdown of why Coal India is a stock that's been on everyone's radar. But talking of that, Elara Capital says that the ongoing LPG supply disruption has not yet impacted the operations at the listed QSR chains. According to the channel checks, major organized players have not reported store shutdowns, and order volumes have remained broadly stable so far. However, some restaurants have begun rationalizing menu offerings to optimize the LPG usage. Sehi is joining in with more details.
Well, yes, so all the tensions that we're seeing in the West Asian region have led to a supply shortage of LPG cylinders. Now, while the government has notified that domestic users will get first preference, it's the commercial establishments like restaurants and QSR chains that are bearing the brunt of this order. So let's understand what Elara Capital is making of this impact. First, on LPG supply disruption, they say that no shutdown or business impact has been seen on the listed QSR companies so far. Aggregators could struggle due to shutdown of standalone restaurants, but listed QSRs, because they are much widespread in nature and they have enough buffers and contingencies in place, they may or may not see a very adverse impact. Listed organized QSR chains have not reported any shutdowns or any store shutdowns also so far. Order volumes have remained broadly stable over the last few days, and some restaurants have rationalized their menu offerings to make the most of their LPG supply, but no impact on business volumes have been seen so far. And QSR companies maintain a inventory of 7 to 15 days. So any disruption that prolongs this could have an issue, but so far everything looks good. In terms of LPG dependence, Elara says that McDonald's and Burger King, that's Westlife Food and Restaurant Brands Asia, roughly 80 to 85% of their operations are electric. For Domino's, that's Jubilant Foodworks, less than 10% of their operations are electric, and they're largely dependent on LPG. So they could have a problem in the near future. And KFC, that's the Sapphire Devyani merger, which will be in place now. The hybrid, they opt for a hybrid model using both electric and LPG fryers, so they have a neutral sort of an impact. If you take a status check on India's restaurants, according to National Restaurant Association of India, India has 6 lakh plus restaurants, and currently less than 5% of them have reported shutdowns. Standalone restaurants are more vulnerable here. And in terms of food tech platforms, Elara says that Zomato and Swiggy are more exposed to this entire ecosystem than QSR chains. They estimate a GOV or an OPD, orders per day, decline could be in the range of 10 to 20% in the next 2 weeks. So this is something worth noting about. Food tech platforms may see near-term margin pressure. This could lead to a 7 to 8% EBITDA downside in Q4 if these disruptions persist going ahead, and channel checks indicate that platforms are willing to offer discounts. Lastly, in terms of stocks view, they say that recent correction in QSR names as a potential tactical opportunity. Fried chicken QSRs may see 3 to 4% same-store sales growth in Q4 on a lower base, which is going to be better than their pizza peers. Zomato and Swiggy are down 3 to 4% recently, factoring a 7 to 8% EBITDA risk. So if the disruption continues, it may be a good entry point at what Elara believes, and prolonged shortages could weigh on the stock performance going ahead. That's what they're flagging off. So that's a roundup on Elara on the QSR impact and, of course, the Swiggy-Zomato impact of this LPG shortage.
All right, so that's the word coming in, that it has hardly been any impact as far as the QSR chains are concerned, though there has been a tweak in the menu as far, keeping in mind, of course, the LPG shortage. But let's talk about the Indian equities that have corrected sharply since the escalation of the Israel-Iran conflict. In fact, Nifty has slipped about 8% from its pre-war highs. Ashesha is now joining us with more on that. Take it away, Ashesha.
Well, yes, so the market has corrected nearly 8% from the 28th of February. That's when the war broke out. And since then, Nifty Bank, that one is down 11%. We have Sensex, which has fallen nearly 8%. And other indices have also fallen anywhere between 6.5% to 8% over the corresponding period. But the big question now is, in this recent correction, if you want to buy, where do the big opportunities lie? So we have curated a list of stocks where analysts see most upside from the current market price. And let's start with the list of stocks from the Nifty 50 pack where analysts see most upside, especially from the current market price. Let's talk about Eternal first, where the 12-month target price stands at 372 rupees per share, implying 73% upside from the current market price. This, remember, is the consensus target price for the 12-month period, which is collected from Bloomberg. M&M, meanwhile, 49% upside. Adani Enterprises, TCS and HDFC Life are some of the other stocks where analysts see upside anywhere between 41 to 50%. And from the Nifty mid-cap and the small-cap index, let's also talk about those stocks where analysts see most upside. We'll talk about the Nifty banking index as well in just a bit. Nifty banking index has some stocks like HDFC Bank, where the 12-month target price stands at 1157, implying 42% upside. IDFC First Bank, ICICI Bank, Kotak Mahindra Bank and Axis Bank are some other top ideas that have come in from analysts with an upside anywhere between 26 to 37%. Shifting focus to the Nifty mid-cap index then, KPIT Tech, that stock is at the top of the list where analysts see 78% upside from current market price. Coforge, Kalyan Jewellers, Hudco and ITC Hotels are some other stocks from the mid-cap space with an upside potential anywhere between 56 to 72%. Shifting focus to the small-cap index then, we have Newgen Software, 12-month target price stands at 834. We have Aditya Birla Real Estate, 5-Star Finance, Agility India and Inox Wind. These are some of the other stocks with an upside potential of more than 75%. So yes, these are some stock ideas that have come in from analysts, especially after the recent correction that we have seen.
All right, with that, thank you so much for joining us, Ashesha. And with that, it's a wrap on this edition of Market Cafe. I'll take your leave. Don't go anywhere because the market is coming up next and we'll take you through all the market action. Stay tuned.
Every business is like a piece of land. From the outside, it looks ordinary. The real truth lies beneath. Dig once, you uncover losses. Dig again, unexpected profit shines back. Sometimes it's the heavy chains of debt. Other times the break of fresh cash flow. But deep below, traps wait.